The future of capital markets is emerging in real time. For more than a century, capital markets have operated under the same basic framework. Banks originated capital, investment firms controlled access, private assets remained largely illiquid, and investors accepted that if they wanted liquidity, they had to go public. That system made sense in a world without the internet, a world without digital settlement, a world without real-time reporting, a world without global connectivity, a world where transferring ownership was expensive, slow, and operationally complex. The system wasn't broken. It was built around the technological limitations of its time. But technology changes markets, and when technology changes, capital markets evolve. Today, we are entering the next major evolution of capital formation, not because of cryptocurrency, not because of speculation, but because technology is removing friction from the movement of capital itself. The internet connected information, mobile phones connected people, artificial intelligence is connecting knowledge, and digital asset infrastructure is beginning to connect capital. The question is no longer whether assets can move digitally. The question is, what happens when every asset can? Consider commercial real estate. For decades, property owners had three options: hold the asset, refinance the asset, or sell the asset. That was it. The problem is that private real estate is fundamentally illiquid. Owners can create value but struggle to access it. As interest rates rise and capital markets tighten, that problem becomes even more pronounced. But what if there was a fourth option? What if ownership interests could be recapitalized, fractionalized, and transferred more efficiently? What if liquidity could exist without a full asset sale? That changes the equation, and commercial real estate is only the beginning. The same challenge exists across virtually every private asset class. Private equity, private credit, infrastructure, energy projects, opportunity zone investments, renewable energy developments, tax credit investments, venture capital. The problem is always the same: liquidity. Capital is trapped inside structures designed for a different era, yet the assets themselves continue generating value. This becomes especially interesting when you examine energy infrastructure. Take solar development. Many people think solar is simply an electricity business. It isn't. At its core, it is a capital markets business. A solar project generates electricity, but it also generates investment tax credits. It generates accelerated depreciation. It generates predictable contracted cash flows. It creates multiple layers of value that can be allocated to different investors. The same concept applies to opportunity zones, private real estate, and infrastructure investments. Increasingly, capital markets are systems for distributing rights. That is where the future becomes fascinating. What happens when ownership becomes programmable? What happens when compliance becomes automated? What happens when reporting becomes real-time? What happens when private assets gain access to secondary liquidity? What happens when investors can access opportunities that historically were available only to institutions? These are no longer theoretical questions. Large financial institutions are exploring these possibilities. Asset managers are building digital infrastructure. Real-world assets are moving onto digital rails. And capital is beginning to flow through entirely new channels. The winners of the next decade may not be the firms that own the assets. They may be the firms that create the most efficient markets, the exchanges, the marketplaces, the platforms that connect capital with opportunity. Because ultimately, the future is not a story about technology, it is a story about liquidity, efficiency, and access. The future will not belong to those who simply control capital. The future will belong to the institutions that make capital move, and it's arriving faster than you realize.